So if you're about to retire or just retired, retirement comes down to a pretty simple mathematical formula. Let's just say you've saved up $1 million in your 401k. Do you actually get to keep $1 million? Well, not necessarily. Why is that? Well, one of the reasons why could be taxes. You see, what you keep depends on what you do about taxes. Let's just say you have $3,000 of Social Security income coming in. Do you actually get to keep all $3,000? Not necessarily, again, because of taxes. Like I said, a very simple formula here. The higher the top number, the smaller the bottom number, right? One minus the other, well, the more we get to keep. So what you can do to optimize your retirement savings and minimize your taxes helps you get to keep more for your retirement. Optimize your retirement income, minimize the taxes on that retirement income. That can give you more money to keep and spend from your income in your retirement, which can mean more activities, more travel, or if it's important to you to pass on a legacy, it could mean a larger legacy that you can pass on. So a common question that I often get from people about to retire or just retired, people just like you, is what is the best tax strategy for retirement? What's the best way to minimize those taxes so we can keep more of my hard-earned retirement savings in my account? And I'll tell you what, there's not just one. And today, because everybody's situation is unique and different, so today we're going to talk about 5 strategies to help minimize the taxes, help minimize that lower number in your equation here, and help maximize what you keep from your retirement savings and what you keep from your retirement income. We're going to talk about strategies that a lot of people miss out on. We're going to talk about strategies for if you're charitable. We're going to talk about strategies depending on what types of accounts that you've saved in. So stick around because maybe one or all 5 strategies could help you minimize the taxes that you pay to the IRS, keeping more of your retirement savings and retirement income with you. For those that are new to our channel, I'm Scott Sierens. I run a retirement planning and investment management firm where we help people understand when they can retire, how to maximize what they can spend in retirement, and how to minimize the taxes that they pay to the IRS. If you're looking for help in those areas, you can go to lifemoneyshow.com and click on the Work With Us tab. All right, so we're going to talk about the 5 strategies to help minimize your taxes in retirement. And as we go through, we're going to talk about who might be or who may be a good fit for each one of these strategies. Now, the first strategy is the one that I find often gets missed. Let's just say you've retired, but your spouse is still working. Well, depending on the income that your spouse has coming in, you can still contribute to a spousal IRA or a Roth IRA. How does that reduce your taxes? Well, if you're paying tax on that money and you contribute to that spousal IRA, you can get a tax deduction. If you go into that Roth IRA, now that money is tax-free. You paid tax to get in the Roth, but tax-free growth. Like I said, a lot of times this one gets missed because one spouse is retired. They don't think that they can contribute anymore to that IRA or Roth IRA. Another part that often gets missed in this is I find that people will sometimes say, hey, I don't have the cash flow to be able to make those contributions. But then we take a look at their overall picture and they have money sitting in savings. Well, when money is sitting in savings, it's generating interest. You get taxed on that interest at your ordinary income tax rate each and every year. Well, some of the things that we've done sometimes for clients, they have an abundance in their savings. And again, one spouse is working, one spouse is retired. And for that retired spouse, what we do is we take from the savings and make a contribution to their spousal IRA or Roth IRA. If it's in your savings account, you're getting taxed on the interest. If you shift it over, you're either getting a tax deduction because you put it into the spousal IRA, or you put it into the Roth where now you're getting tax-free growth and tax-free withdrawals in your future. So how does that help your taxes? Savings account, taxed on the interest, ordinary income tax rate, shift it over, you're getting tax deferred or tax-free growth depending on the situation. Now, who may this strategy be a good fit for? Well, I'm guessing you caught onto that one. If one spouse is working and one spouse is retired, depending on the income that you have coming in, could be a good fit. One spouse working, one spouse retired, and you have an abundance in your savings account, could also be a good fit for this strategy. One more thing on this strategy, I have a video about spousal IRAs. So when you're done with this video, I'm including a link above as well below in the description. So when you're done with this video, if you want to see more on that, you can click on the link to watch the video on spousal IRAs. Okay, strategy number 2, Roth conversions. I found that most people have saved right here into their 401ks, IRAs, 403bs, 457s, money that hasn't been taxed yet. So every dollar that you take out of those retirement accounts is going to get taxed at your ordinary income tax rate. And you see in your 70s, you're going to be forced to take income out of those accounts, meaning forced to have taxable income on your taxes. That's called required minimum distributions. This forced income, and meaning required minimum distributions, can create quite the retirement tax surprise. And actually, I created a video on that a few weeks ago, and I'm going to create a link to it below in the descriptions if you want to go and see what that retirement tax surprise is. But in summary, what it is that these RMDs could potentially have you with future higher taxable income than where you're at today. So doing a Roth conversion, which is shifting money from your 401k, IRA, 403b, 457 plan over to a Roth. The Roth then grows tax-free and all of the withdrawals are tax-free. The reason why you might want to consider that is you pay tax today when you make that conversion. So you're paying tax today at known rates. And if you feel you're in lower rates today than where you would be in the future, that's how you minimize that bottom portion, that tax portion of our retirement formula. So you pay tax today at a known rate, you get it over to the Roth where it grows tax-free, and you make those withdrawals tax-free. So you can either go with the IRS's plan, which is those forced income, forced distributions that you have starting in your 70s, or you can create your own plan to help potentially reduce your taxes. Now, who might this be a good fit for? Well, if you've saved primarily into those IRAs, 401ks, 403bs, 457s, then Roth conversions may be a good fit for you. That's where you want to consult with your tax professional as well as your financial professional. Another place where it might be a good fit for you is if you've saved into all of those accounts and you're retiring before your RMD age. So you're retiring before your mid-70s. Now you might have some years at lower income where then you can really do some Roth conversions to help you save on taxes in your future. Strategy number 3 is qualified charitable distributions, sometimes called QCDs. Now I'm just going to use an example to help you understand this one. Let's just say you give to different charities $5,000 a year, either to one or to multiple charities. Well, where do most people give this from? A lot of times they're just giving it from their checking account. And let's say they're getting that money in their checking account from their IRA. Well, as we talked about before, IRA money gets taxed because it comes out as ordinary income. Let's just say they're in the 22% bracket. That's $1,100 of tax to give to the charity of their choice. Now, instead, let's just say we use the QCD process and make a qualified charitable distribution directly from the IRA to the charity. Well, guess what? In that case, since it's not coming out to the checking account, there is no tax on it. It actually reduces any other taxable income coming out from the IRA. There is $0 in tax in that situation. So qualified charitable distribution might be a way, if you're charitable, to help reduce the taxes that you're paying on what you're giving to charity. Now, who might this be a good fit for? Well, first off, you have to be over age 70 and a half to be able to utilize the QCD process. So you have to be over age 70 and a half, plus you'd have money in your IRAs and give to charity. Now, before we get into number 4 and number 5, some additional ways to help reduce your taxes in retirement, I wanted to let you know about our free guide to unlocking hidden tax savings opportunities. Within a few minutes, you could potentially have some actions to help you minimize your taxes in retirement. Now, you can get this free guide at lifemoneyshow.com/taxes. Again, that's lifemoneyshow.com/taxes. Strategy number 4 is your withdrawal strategy, the way that you determine to take money out of your accounts. So let's just say you have money saved in different account types. There's three, the IRS looks at your money in three different ways. There's the taxable account type, the tax deferred account type. A lot of people are familiar with that. That's the IRAs, 401ks, 403bs, 457s. And then you have the tax-free account type. That's your Roth 401ks, your Roth IRAs. Each of these is taxed differently. Let's start with the taxable. With the taxable bucket, you're taxed on interest, dividends, and gains. And depending on what types of dividends and depending on what types of gains, you could be taxed at ordinary income tax rates or long-term capital gains rates. But in this bucket, you're taxed each and every year if you have interest, dividends, or gains. The tax deferred bucket, that's the one we were talking about earlier. All of this money, when you take it out, you're going to get taxed at ordinary income tax rates. And then your tax-free bucket, grows tax-free, withdrawals are tax-free. So depending on how you take money out could make a difference in regards to the overall taxes that you pay. See, a lot of times people just think, oh, I'll just take money out of my IRAs and 401ks. But what they don't realize is as they're taking money out, right, it continues to raise their income taxes, raise their taxable income. And so if they go over certain tax brackets, next thing you know, they're pushing themselves up into another tax bracket, another tax rate on some of that money. But maybe instead you just go up to certain tax brackets and then grab some money from your taxable bucket, grab some money from your tax-free bucket. That's how you help level out your taxes and minimize the taxes that you pay on that IRA 401k money over your lifetime. Now, I'm not going to go into more detail on this because we actually have another video on withdrawal strategies. I'll include a link to that video in the description below. But who might be a good fit for this strategy? Well, you might be a good fit for this strategy if you've saved money into multiple of the different buckets, meaning you might have money in your savings account or your brokerage account, a trust account, a joint or an individual brokerage account. Plus, then you have money in your 401k, IRA, 403b, and you might also have money in the Roth. So you might have money in all three, or you might have money in two. If you do have money in multiple tax buckets, then this might be a good fit for you. Strategy number 5 is asset allocation. Now, I'm going to use the same chart here to help explain this one. As I had mentioned earlier, the taxable bucket, you get taxed on interest, dividends, and gains. Let's think about what you could potentially put from your investment accounts in that taxable bucket. Maybe you're using stocks, maybe you're using bonds. Bonds produce interest. Interest in the taxable bucket gets taxed at your ordinary income tax rate. Stocks or stock funds produce gains and they produce dividends. Now, dividends could get taxed at ordinary income tax rates, or qualified dividends could get taxed at long-term capital gains rates. Also, gains under 1 year, short-term gains, ordinary income tax rate. Gains over 1 year, those are long-term gains at a more favorable rate, that long-term capital gains rates. So when you think about it, you have bonds in your taxable bucket, that's producing interest. For sure, that's going to get taxed at ordinary income tax rates. Or you put stock and stock funds in your taxable bucket. Now, maybe you're able to shift the dividends and the gains over to long-term capital gains rates. Take those bonds, put them in your tax deferred bucket, because guess what? All tax deferred money is going to get taxed at your ordinary income tax rate. So some small, I don't want to say small, but some shifts just in where your investments sit can help reduce the taxes that you're paying each and every year. Now, who might this be a good fit for? Again, if you've got money in multiple buckets, right? Investments sitting in taxable accounts, investments sitting in tax deferred accounts, investments sitting in tax-free accounts, this strategy might be a good fit for you. As I mentioned at the beginning of the video, retirement can sometimes be boiled down to a really simple formula of what you have coming in, your retirement accounts, your retirement savings, minus what's going out in taxes. And whatever you do to optimize the top, minimize the bottom, means keeping more of your hard-earned retirement savings and income with you and in your account. So hopefully you found these 5 strategies helpful. Now, we do have more in-depth videos on these strategies or some of these strategies. And I'm going to include a link to those in-depth videos below in the description. Also, if you found today's video to be of value and benefit, and you want to see additional videos on retirement topics like understanding how to help minimize your taxes, how to help maximize your Social Security and your retirement spending, well, subscribe to our YouTube channel as we're coming out with new videos on topics just like those each and every week.